Hi, Assalamualaikum, and good evening to all, and Selamat Hari Raya for those who are celebrating. Before we start our online webinar, today, unlocking opportunities in CME precious metals from safe haven to tactical trades. I will give a short introduction about Philip Capital. So a disclaimer, this presentation is not reviewed by Security Commission Malaysia. So this presentation only for educational purposes only. So before making any investment decision, make sure to have a study and do a deep research before making any decision. So about Philip Capital, we are incorporated on 7 October 1995, formerly known as Philip Futures Sdn Bhd. We are trading participant of Bursa Malaysia Derivatives and participating organization of Bursa Malaysia Securities. And we also a holder of capital market service license, which means we are eligible to sell this product to our client. And as you can see, this is our office nationwide. We have 11 offices across Malaysia. On the south, we have at JB, Melaka, and on the north, we have Penang and Alustar. And our HQ is at Kuala Lumpur, and we also have Kota Damansara at Selangor. At East Coast, we have Kuantan, and not to forget Sabah Sarawak, we have Kuching, Sibu, and Kota Kinabalu. So if you come by, and if you want to drop by to our offices, you can just make a call first, or you can just drop by, and our dealer will assist you accordingly. And this is our global net worth, which means we have offices across globe, which means Fiat Capital not only have in Malaysia or Singapore, we have across the globe. And this is our coverage, not only Malaysia or Bursa Malaysia. We do also have Singapore, Hong Kong, Japan, and US. We have CME, CBOE, and in Europe, we have US and also ICE. And proudly to announce that Philip Capital is your top choice broker. We are champion of best retail derivative trading participant. And I would like to say that because of our client, we are here. So I want to thank you, our client, for sticking with us until who we are today. And why Philip Capital is one-stop solution for your trading. Because the first one is our product. We have three main products: futures, equities, and also CFD. For futures, we have index, agricultural, metal, energy, and also crypto. For stocks, we cover Malaysia, US, Hong Kong, Singapore, and also Australia. And for CFD, we cover for Malaysia and also US market. And why Philip Capital is your broker of choice? The first one is because award-winning multi-asset broker. As you can see in the previous slide, we have won award from Bursa Malaysia. And then we have 24-hour broking and execution support from Monday to Friday. So you don't need to worry about you trading on the night time or you trading on the US market. And we do have advisory service. We have one-to-one coaching for those who need it. And we give latest market news in our social media or Telegram. And then we have wide array of product, as we can see in the previous slide. We have a futures, stocks, and also CFD, and cover most of the market. And we also have no platform fee. So our platform doesn't have any charges when you trade on it. And this is the one that I mentioned to you, our one-to-one coaching. So we will divide into two sessions. The first one is product knowledge. We give introduction to futures, CFD, or stocks trading. For those who are maybe a beginner, who want to know more, we give a basic introduction. And then the second one is a platform coaching. So for those who are want to use our platform, we will give guidance for how to use our platform. And we have weekly market calls every Monday. At 11 a.m., we have market view and updates. And on 8 p.m., we have a live counter technical analysis. And this QR code will bring you to our website to show our upcoming seminar and webinar. And every month, Philip Capital do have a seminar and webinar. You can check it out. You can take a screenshot or take a photo of this QR. And if you want to join, you can just register online. And our seminar and webinar is free. We have no charges. So if you maybe you see in our social media that if we have a charges to join our seminar or webinar, there might be a scam because our webinar is completely free. So you don't need to pay anything. And this is our online account opening QR. So we'll bring you to our website. If you're interested to open an account now or after the webinar, you can do it through online. So you can open stocks futures through online account opening. And this is our trading platform. For futures client, we use a Nova. Nova have over 90 technical indicator. You can buy and sell directly from the chart. We do have market depth trading tool. And if you want to try our Nova platform, you can scan this QR for the demo account. So you can just try it out and see how our platform works. And proudly to announce, Nova is powered by TradingView. So what does it mean? It means that you can link your Nova account with TradingView and you can trade directly from TradingView. So you don't need to open Nova. You can just use TradingView to trade. And we go to our promotion. Everyone loves promotion. Everyone loves sale. And the first promotion we have is grow your portfolio with CME micro features. So this promo is when you open an account and subscribe to CME exchange, you are entitled to get 100 ringgit trading credit. So it will be go to your trading account and you will enjoy trade protection up to 100 ringgit, which means if you trade, you're having a loss, you have 100 ringgit to cover for you. And you can earn monthly reward when you trade more and more CME micro contract. So if you want to know more about this promotion, you can just scan this QR or just go to our website and click promotion. And this promotion is until 31st July this year. Next one is unlock Pulsar and US CFDs with Nova. So CFD is using a real-time market data, no platform fee. You can just trade a CFD using Nova. So CFD is a smaller portion. You can just buy a stocks or index using partially. You usually stand to 30% from the real price. So you can just buy in smaller portion and size. So if you know more about our promotion about CFD, you can scan this QR code and let us know if you want to open an account. And now, probably to announce that you now can own a slice of US share at flat fee of 99 cents. So now you can buy top companies in US with a fractional share. We give a free real-time market data and no platform fee. So if you want to know more about our promotion of this fractional share, you can scan this QR code or go to our website. And now we will starting our webinar for today, unlocking opportunities in CME precious metals from safe haven to tactical trader by Mr. David Ng. So Mr. David Ng is a full-time proprietary trader with Iceberg Exchange Berhad, a local prop trade based in KL. So he has done an extensive research and well-versed in commodities and also index market. Currently, he trade Malaysia Index and crude palm oil in futures market. And he holds a CMT designation as Chartered Market Technician or CMT. So I will now, without further ado, I will pass the floor to Mr. David Ng to continue the webinar for tonight.
Yep. Thank you, Aiman. Just allow me to share my slides. Aiman, could you able to make me a presenter?
All right. So
Aiman, just a quick sound check. Can you hear me and can you see my slides?
yes, I can hear you and I can see your slide.
Okay, that's great. Yeah. So thank you, Evan, for the very kind introduction, and thank you for the audience for joining tonight's session, and obviously Selamat Raya for those who are celebrating. So yeah, I think it's an opportune time to be talking about precious metal. Given the fact that if whether you are trading gold or silver, both these spaces has actually experienced a lot of volatility for the past couple of months. Even before the onset of war or Middle East conflict, we have seen how precious metal has actually experienced a lot of price fluctuation and volatility. Now, obviously, if you attended some of my previous sessions, I always emphasize this. When markets are very volatile, is obviously opportunity presented, but it's also risk involved as well. So as a trader, if you are navigating the market, it's important for us to always have a way to manage the risk, in particular especially during these turbulent times. So just start. I think just before I start, I would just like to also thank Philip Capital as well as CME for inviting me to speak on today's topic. So any recommendation that's presented here is purely for educational purpose. Shouldn't be construed as any recommendation to buy or sell. So if you are new to futures, I think you're in good hands. You can always consult Philip Capital representative. They are more than happy to help you to engage or to even kickstart your journey in futures trading. So futures trading is a derivative instrument. It's highly leveraged. So always make sure you must consult a licensed representative in this area. Now, I think in the next half an hour to 45 minutes or so, I'm just going to cover on basically when you look at precious metal, what are the key factors that drive prices. So looking at things more fundamental, and also I think in the second part, we want to navigate how can we navigate, especially during these turbulent times, in terms of trying to trade the prices that we are seeing in the market through technical tools that we can use and we can deploy. But most importantly is that at the end of the day, whether you're looking at things more fundamental, whether you're looking at things technical, it is important to always must have a way to manage your risk. Risk management is always key when markets are very volatile. So just to give you a snapshot just to give you a snapshot and overview of where prices are, you can see that I think early part of this year, before the start of the Middle East conflict, you can clearly see that actually precious metal experienced a lot of volatility, and obviously prices actually rallied to substantial levels. If you look at where gold and silver is, they make all-time high prices this year, especially for silver. Silver was pretty much a sleeping metal right until I think end of last year and early part of this year, where it starts to gain traction. So silver is the dynamics of silver market is that the recent rally that we are seeing, especially in the silver market, is mainly driven by the AI team, which means that silver is also not only known as precious metal, but it's also used as an industrial metal. There's an industrial usage for it, mainly used for your green energy, mainly used for your AI. Infrastructure like data centers and whatnot. So silver has a bit of industrial demand, and because of that, that actually created a rally in terms of where the demand is suddenly that you can see there's greater appetite for silver in the market, and therefore pushes silver into new heights. So we also seen a similar parallel movement in terms of the gold market as well. So really, I think last year and this even early part of this year and towards now as well, we can see that both these precious metals actually increased quite substantially. But for the silver market, it does. If you look at where this chart that I presented here, you can clearly see that silver clearly outperformed the gold market especially in the early part of this year. Now the key question is that I think both these markets has since normalized. So later on when I show you the gold and silver ratio, you can clearly see that both these markets are actually quite balanced. But eventually, I think if you look at the precious metal space, you look at relatively in terms of relative valuation, silver still have a bit of upside as compared to gold in certain areas. Now, the case for gold, I think majority of us will probably be thinking that gold as a historical asset, it has tested the time, as asset that holds value, as an asset that usually people will use it as to diversify risk, and even I think if you just look at where s- gold as a commodity, you can look at is being exposed to many different contracts as now having exposure to the gold market. So therefore, there is plenty and abundant of liquidity. So because of I think these three major characteristics, it makes gold quite appealing in certain ways. So there's always now the narrative of gold is that gold has reached all-time high levels at close to 6,000 or even above 5,000 US dollar per troy ounce. I think that created a lot of interest. It generated a lot of interest among whether portfolio managers or fund managers to actually look at gold as whether to diversify or to hold gold as a way of diversification, as part of their portfolio, attributes. So I think that's where gold starts to garner interest. And I think in time to come, the narrative of gold is still remains that is a liquid asset, and is quite in the major function to diversify risk, and also to enhance return is pretty much there. So I think that's something for us to consider if you look at the narrative of gold over the longer period in time. Now, in terms of performance of gold, I think needless to say, over the past year, I've seen how gold has actually rallied almost close to that 50 to 60% in the past 1.5 years. So really, I think gold has gained substantial traction. Now, if you compare to other asset classes, like even I think the closest one that we can probably compare with, I mean, if you discount the recent rally in crude oil prices in terms of commodity basket, but if you look at other asset classes, I think even equities, the US equities especially, are also gaining traction in terms of their relative performance. But gold, on the other hand, on its own, has actually generated quite a lot of return in terms of prices over the past 1.5 years, mainly driven by supply demand dynamics and also the appeal of gold. Once it reached a certain price level, like I said, it created interest, and therefore I think that in a way has attract attention and therefore hopefully translate to greater demand for gold. Now, if you break down in terms of supply demand fundamentals of gold, I think the demand perspective for gold is very clear. There's only four major pillars of key demand drivers. Firstly, I mean, majority of it actually comes from jewelry demand, which is your gold jewelry and whatnot. Technology is quite a small portion. Investment is the biggest, which means it mainly driven by ETFs, by gold product flows. And I think last but not least, the central bank. Now, central bank recently has actually been in the news in terms of generating gold demand. You can see certain countries, especially China's central bank, has actually been aggressively buying over the past couple of years. There's obviously a certain narrative to why China has been aggressively buying. It could be a shift, away from monetary asset into a physical asset like gold, as a way to diversify away from US holdings and whatnot. I mean, that could be a potential reason why China has actually been aggressively buying gold on the open market. But I think because of this buying pace that we've seen in China, it's actually propelled gold into a new level in terms of prices. So the key question to ask ourselves is that can China continue to drive demand moving forward? So it's always a question of price. If the price is just too high, as what we're seeing over the past couple of months, and China is also a very price sensitive buyer. So again, I think it's when the price is too high, it will definitely taper off demand. But once prices retrace to a certain level, then it created another. It will definitely generate interest again. So I think that's where we really need to watch out for. So right now you can see that gold prices are still quite elevated. So therefore, it's actually going to taper demand along the way. But I think over the medium to longer picture, you can see that central bank buying is still quite aggressive and in a way is supporting the market in terms of prices. So yeah, you can clearly see what drive gold's demand. No, you can't run away from ETF flows. ETF flows are basically investment. Like I said, now there's so many products that derive the value in the gold market. So therefore, it created a lot of abundance of liquidity. And I think traders or even retail investors are participating in the market through all these products, and therefore, actually, in that sense, it created interest. So you look at a past couple of quarters, it was actually very strong demand for gold. That explains why the rally in gold is actually quite sustained. But unfortunately, over the last quarter, you can see a bit of softening. Once I think gold reach above the 5,000 mark, that's where you start to see a lot of volume coming from market. So that means those who have bought earlier, I think that's a price entry where a lot of people will start to liquidate or exiting their positions. So you can see that actually funds are get from a net inflow is actually becoming a net outflow from the gold market. So that explains why you can see price softening towards the end of the first quarter this year. Now, just talk a little bit on silver. So silver, the demand of silver, like I said, primarily quite driven by industrial as well. So with the rise and boom of AI and the demand for AI infrastructure is gaining, is increasing. So therefore, that translate to a rising demand for silver as well in terms of industrial usage. So you can see over the past 2 or 3 years after the COVID-19 pandemic, the AI boom really kicked off. So that actually also created additional demand for silver on the open market. So that also in a way supports the price rally for silver market as well. So I think do watch out. If you look at it, AI is still a continuous theme. Then most of the AI companies are spending massive amount in terms of upgrading infrastructure, or expanding infrastructure. So therefore, that also increases the demand for silver in certain aspect as well. So industrial demand can continue and could continue to be a key driver for the silver market for quite a while. Now, so despite I mentioned earlier, gold has hit an all-time high above 5,000 per troy ounces. Since then, I think it reached prices started to retrace. Obviously, like I said, at that kind of price level and the kind of rally they have seen over the past years is definitely going to create interest, especially for those who have entered the market earlier. Created interest for them to exit their positions or to book their profit. So really, I think with high prices, obviously, that also will create a destruction of demand where I mentioned earlier, China's central bank will always be price sensitive. If the prices are too high or remain quite elevated, they'll probably wait for the market to retrace. Then only they'll probably to observe the market to see again if there's any other opportunity. So you can see that I think currently the market is still quite consolidating, but on a short term displaying a short term downtrend tendencies. But overall, the longer term picture for gold, if you still look at it, it's still pretty much an uptrend market. But obviously there's now a period of consolidation, and if you look at short term technicals, the chart is still pointing to you that there's a possible downtrend in place, and right until then, depending on how long the consolidation takes, hopefully that will create a base for the next potential price rally in the market. So if you look at it in terms of investment flows and you compare that to where gold prices is very clear. I think when prices reach a peak of 5,000, you can see there's definitely created a lot of interest, especially for the investment side to be going to the market to offload their positions. So right now, I think volumes are starting to moderate, showing you that the market is a bit more balanced. So the key thing to watch is that what drives the market next for the gold market. Eventually that will also dictate where likely the gold prices will head. Now, the long-term narrative for gold is still quite appealing as a store of value, as a safe haven asset. It still remains its predominant role. So as long as gold is used in these functions, I think over the longer or over the medium to longer term picture, gold remains still quite attractive. So like I said, I think if there's any retracement or consolidation in prices, could be just forming a base for the potential next rally in the market. Now, in terms of liquidity, like I said, I think trading volume has actually increased significantly. So I think towards the end of the end couple of slides, I'm going to share with you also, if you are trading gold futures in particular on the CME exchange, I think the introduction of micro contracts is actually helps to gain exposure for a lot of traders to at least gain a piece of gold trading in the market. Those days, if you recall, if you trade one lot of the normal size gold futures contract, is actually requires a lot of margin. So now with the introduction of micro, which is 1/10 of the size, it's actually making it more feasible. So I think margins later. I'm just going to share you what the margins like. So with smaller margins, definitely it is making easier entry for traders to participate in the market. So liquidity in the gold market or gold exchange is no longer an issue. It's actually a very liquid market. In fact, I think sometimes it surpasses other asset classes as well. Now, in terms of volatility of gold, clearly, I think in the past couple of months, even before the onset of the Middle East conflict, we can clearly see the volatility of gold has actually risen quite substantially. So those days, it's normal for you to probably experience a daily range about 40 to 60 US dollars as a day high and day low for a particular trading session. Now, I think if you just look at where gold market is, the daily volatility or daily range of a particular gold market is on average above 100 US dollar. So you can see that the range has actually, the range of prices has actually expanded. So that means higher volatility. Now, if you compare into other asset classes, gold still remain fairly less volatile, but it can become more volatile in certain occasions. So having said that, I think generally the market across all major asset classes has experienced more volatility. Now you can say this thanks to Trump. He's making everything more volatile. So as a trader, regardless which space you are trading off, it's very crucial that whatever it is, maintain risk exposure up to the minimum, because if any news flow that would come in that can disrupt the market patterns, at least you're not so exposed, or your risk is more measured in that regards. Now, this table is showing you the ETS fund flows according to region. You can see really, I think the big increase is coming from Asia, and in particular China, and to a certain extent India as well. These two countries are very large in terms of demand for gold, but you can see other pockets of countries are also increasing exposure, like even Turkey as well, to a certain extent. Now, I think Turkey, before the onset of war, you can see they're massively buying, but I think during the war and during the couple of weeks into the war, you can see that they're actually trying to offload their gold, trying to shore up their currency because of the strength of the dollar, and it is affecting their own currency. So, it's more of a balance play, more macroeconomics play. But I think Asia is a net demand for gold, and it's mainly coming from China and India. China is very clear. Central bank buying is still quite aggressive. Now, obviously, I think price last couple of months is actually quite elevated. So I think let's watch out if prices do come down for gold in general. I think that will create interest again for China central bank to start looking at the gold market, to probably be participating in the gold market. So yeah, like I say, the ETF flow last month was actually last couple of months actually recording net outflow, suggesting that I think recent peaks in gold prices actually attracted a lot of interest, a lot of buying, a lot of selling interest, because it actually create a lot of opportunity for people to exit their current long positions in the market. So if that continue, definitely it's going to depress gold prices forward. But hopefully, I think when gold prices depress to certain levels or consolidate to a certain price level, that again will create or generate buying interest again. Yeah, so you can see central bank buying. This is showing you how central bank have been buying the gold market since the past couple of years. Really, I think things gets a bit more aggressive towards the second quarter of 2022. So, and this is mainly driven by China. So I think you can see that central bank buying on the average has actually increased over the past 5 years or even the past decade. So hopefully this momentum can sustain. If this momentum can't sustain, then it's definitely going to be pressure on gold prices. So going forward, it's really much depending also on how central bank is going to react. If central bank continues to buy, I think that's going to create a bit of support for the market. Yeah, so you can see, I think ETS inflows are pretty much strong over the past couple of years. Only I think this year, the first quarter and the last quarter last year, when prices hit all-time high of both 5,000 per troy ounces. I think that's where it actually created a lot of selling interest. So I think now price has actually tapered down and starts to balance around 4,004 to 4,500 US dollar region. Hopefully that's a base. And eventually I think that will hopefully create or generate buying interest, and eventually we can see record positive inflows into the gold market. Yeah. So ETF outflows and inflows are an important parameter to watch. And if you are looking at gold market, if you look at data per se, and you want to gauge the demand for gold, I think ETF inflows and outflows are a very good barometer. Now keep in mind fundamentals data like reports from World Gold Councils tend to delay by a month or two. So once you read those reports, they are pretty much a month or two late. So usually price has reacted to it. But I think these are all parameters or even factors that really, in a way we need to really understand and gauge, because all these factors in certain ways does drive the gold prices in certain aspect. Now, this is just showing you the duty on gold. So I think increasing import duty, especially what India is doing and what to some extent China is also doing, is in a way to protect their currency situation. So I think India, the jewelry demand is very strong year in year out. The seasonally buying and seasonal selling, especially for jewelry demand in India, is actually very pronounced. So whenever the government reckons that just to balance the trade deficit, uh, because of importing too much of gold, they tend to elevate or tend to raise import duty on gold, and therefore that actually taper demand off. Now, this may have not an immediate effect, but if you look at over the medium term, it does have an impact. Keep in mind, India is actually a very big buyer, and jewelry demand consisting of 30% of the global demand for gold, so it's still quite substantial. So any policies that's got to do with import duty when it comes to the gold market, gold import duties can have impact on prices as well. Now, if you look at role of the gold market, in periods of high inflation, we have seen over the past historical basis, gold tends to perform quite well in periods of high inflation. Now, I'm not saying that now we are in a period of high inflation, but you can see a pocket of signs that inflation is going to be a concern as we head into the next half of the year. Reason being is because escalating energy prices and is in staying there quite persistently. So that's actually pushing general prices on a higher side, which means inflation is going to be a concern or closely watched by central banks. So like I said, in periods of high inflation or higher inflationary rate, normally that will benefit gold prices. Now again, these are all historical trends. I'm not saying that based on historical this should happen this time round. Again, I think things can be different. We usually use it as a guide. So in periods of high inflation, we should see a bit of support for gold market based on historical patterns and trends. Now, if you look at currencies per se, majority of major currencies is a monetary tool that a lot of central banks use, and they usually, if they want to expand monetary supply, usually they expand monetary currencies into the circulation. So you can see the purchasing power has actually been eroded, since the many decades. In that sense, gold as a store of value still remains intact. The only downside for gold is that it's a asset classes that's non-interest yielding. That means it doesn't yield you any interest if you hold gold. It's purely based on the precision of the value of gold. So unlike other asset classes, whether it's fixed income instruments or whether you talk about stock markets or equities per se, they does yield a certain amount of interest. So that comes a question where if in periods of high inflation, usually accompanied by periods of high interest rate as well, as central banks try to rein in inflation. So as a result, when you witness a high interest rate environment, normally you expect gold tend not to be favored just because it's an asset classes that doesn't pay you any interest. So that again we have to be mindful of that. But I think this chart speaks a lot. You can because if you look at it, I think the money supply in circulation, especially in the US, is clearly on an upward basis. Now, when you have so much money that is circulating in the market with such a big expansion of money supply, it's definitely bound to create a inflation rate that will probably be better off when you're protected by holding gold. So in a sense, I think with expansion of money supply, on the longer run, you should expect gold prices to move in tandem as a way to rise in tandem with the inflation rate. So I think that's something that we will have to consider, especially when you are faced with inflationary mode or inflation pressure that is rising. So I think that's something, if you are trading the gold market, you should watch closely as well. So yeah, interest rate and gold prices, you can see that really, when you have period of high interest rate, normally that it doesn't favor the gold prices that much, because like I say, it's a asset class that doesn't pay you any interest. So it's purely based on price appreciation. So when interest rate starts to go up, in line with inflationary pressure, I think that's where a question of, whether gold prices will be pressured in certain ways. So do watch out. I think now with the new Kevin Walsh as a next Fed chair, so really I think we have to watch out what's he going to do. And if you've been trading the gold market for quite some time, you always notice that FOMC days markets are more volatile. So if you want to avoid, generally a less volatile market, you should avoid those FOMC days going forward. So yeah, I think that's something to watch out for if you are watching or trading the gold market. So yeah, so this is basically the US bond yield. You can see that the 30 years bond yield interest has actually been climbing off late. In fact, it actually surpassed the 5% mark, which is a psychological important level. When you have such a high interest rate on longer dated bonds, it's just telling you that inflationary or interest rate is bound to raise or to bound to hike up in the near future. And like I said, high interest rate environment may not benefit gold just because of the interest rate costs that is attached to the gold market. Now, Fed policy, I think when it started off this year, things were looking actually pretty well. In fact, I think interest rate were expected to, I think probably they're expecting 3 or 4 rate cut cycles when we started off in the early part of this year. But things took a turn. I think pretty much now the view has changed quite dramatically. In fact, I think people are or market is expecting that interest rate cycle may actually be on the rise this year with a potential 1 or 2 hikes along the way. So really crucially, if interest rate will start inching higher, it's going to be a pressure on gold prices going forward. Now, with dollar relationship and gold, you can see that weaker dollar tends to in a way tends to benefit gold, and with a stronger dollar, it's usually the reverse. It tends to put pressure on gold market. So really, I think dollar strength plays a quite important role, but it's not a significant factor that drive gold prices, because there's always a confluence of factors that actually affect gold or drive gold prices. But I think it's worth to watch. I think regardless, with interest rate expected to rise, you can probably see the strength on the dollar will start inching higher as well. So that can also play out. That means that will also put a downward pressure for gold prices. So that's why off late, in the past couple of weeks, you can see pretty much the short-term downtrend in gold is actually quite persistent, given the fact that I think US dollar is actually strengthened quite a fair bit in the past couple of weeks. So whenever dollar strengthen, that usually means pressure for gold prices, and that's both to watch out for going forward, especially in line with interest rate expectation that's expecting to go on a high, slightly on a high end, given the fact inflation is also expecting to go higher. Now, if you are trading the gold market, this is what we call looking at net positions in the market. So COMEX or CME exchange, pretty much they do come out on a weekly basis, the net positions of the market. So important to take note of is that when the markets are rising, especially prices are rising, if you have net long positions, after factoring all the players in the market, and most of the players are holding net long positions in the market, and those figures are rising, that usually means it's a good thing. That means the price rally can sustain itself, because the logic behind it is this: that when people thinks that there's more upside for gold prices to go even higher levels, they tend to hold positions. But if they believe that the current price is pretty much peak, normally if they're holding to long position, they will start to exit the market, which usually translate to lower net positions. So when that happens, especially when you start to notice lower net positions, especially during a rising market, we have to be more cautious. usually it entails that the current rally that we see in the gold prices could not sustain itself. So you can see current net positions are slowly declining. So that's also an indication to you that the current downtrend, the short-term downtrend we are seeing in the gold market is quite in line with a lot of market participants starting to turn away the closing their net long positions and probably trying to initiate net short positions in the market. So watch out. I think net positions weekly, monitoring the net weekly positions in the market could probably entails or probably foretell the sentiment of gold market in the near term. Now, this is looking at gold and silver ratio. So I've talked a fair bit on gold. I just want to also bring attention to the silver market as well. So clearly this year you can see that this gold silver ratio, if you look at over historical basis, it's actually been trading at quite a close range between 85 to around 80 ratio range. Now I think early part of this year the ratio has actually went to as low as almost 45. So that shows you how dramatically silver price has actually rallied relatively to gold market. So in that sense, really you can see that the outperformance in silver was actually definitely be something to watch out for. Now currently we are still pretty much the ratios are still pointing to you that silver prices are still quite elevated relatively to the gold market. So still indicating to you that silver is still a bit overpriced compared to gold. Now, whether overpriced or underpriced is on a very relative basis. So it's just showing you that if there's any change in narrative, especially for a precious metal space, silver would tend to react more as compared to gold because of this ratio that is indicating to you that silver is pretty much overreacted. So I think watch out. I think the ratios right now is still pretty much looking at silver to be more overpriced compared to gold. Therefore, I think presenting more opportunity in the gold market as compared to the silver market for now. So let's look at things more technical. So I've mentioned a lot on what are key drivers that drive the precious metal space, especially for gold. I think watch out. Interest rates is something that we really have to watch out for. Together with US dollar strength as we go into the next couple of months with interest rate decisions in the upcoming FOMC. Obviously, with the new appointment of Kevin Walsh as the Fed chair. Now, commodity prices, especially energy prices, are very elevated. That means inflation pressure is also high. So that also push the narrative that we should face higher interest rate in coming future, which definitely going to be a dampener for gold market. Having said that, I think the positive news flow is still looking at risk. As a safe haven asset, gold still remains quite a pivotal role. So Middle East conflict is always an escalation and de-escalation. So when there's conflict, gold tend to be favored as well. I think that's something that's also pulling the positives aspect for the gold market or the precious metal market. Now, let's look at things more technically. So you look at the charts. This is looking at gold prices over the past 2 years. This is a daily chart. You can clearly see, it got tested, I think, early part of April, where prices went as high as 5,000, above 5,000, and it couldn't last. And it went to test as low as, I think it went to test about 4,001 as a potential support over there. And anything that's 5,000, 4,000 is all psychological. It's always what you call psychological resistance and support because of the numerical aspect of it. But clearly, if you just plot a 50 period and 200 period EMA, you can clearly see that the market in gold is still quite consolidating. But the short-term trend indicates to you is a possible downtrend in place. So with a potential support or at about 4,300 US dollars. So once it breaks that, that's breaking the 200 period EMA, which potentially foretell that the gold market is heading for a downtrend or there's a change from an uptrend to a downtrend market in the gold market. Now silver is also very similar. In fact, I think silver shows a bit more upside because it's hugging along quite well, especially on a 50 period EMA, which is the blue line here. Indicating to you that the silver market is slightly more positive in terms of the technical front as compared to gold market. Despite both of these metals are in the precious metal space, when they move in line, they tend to move in line if there's any narrative that shift the precious metal sentiment. So but silver seems to show a little bit more support as compared to gold, which short term wise is indicating to you there's a potential downtrend in place. Now, in technical trading, there is many style that we can deploy. I think majority is split into two major categories. I think the first category is looking at trend trading, using technical tools, trend tools that to trade with the market trend. Now, another way is that when markets are ranging, there is a tool that what we call range market trading. So it's usually more of mean reversion or trading at a specific range of the market. So Jenny, if you are more to trend trading, there's obviously trend tools that you can use to probably seek out whether the market is trending in a certain direction. So what I want to introduce here tonight as well as a technical trend tool is what we use at Heiken-Ashi candles. Now, Heiken-Ashi candles are getting more popular because the fact that it's easier to illustrate trend on a particular time frame that you're looking at. So the major comparison between Heiken-Ashi and Japanese candlestick is that Heiken-Ashi is mainly used for looking at trends. Japanese candlesticks, or your normal candlesticks we call it, is normally used for reversal of the market. And the problem with Japanese candlestick, not I won't say it's a problem, but it takes a lot of effort to really master Japanese candlestick, because if you look at Japanese candlesticks function, there's a lot of patterns that or configuration that you really have to observe in the Japanese candlesticks, and therefore it takes time. Now, Heiken-Ashi, there's only 3 distinct patterns that you need to know, and with these 3 distinct patterns, it's actually making it easier for you to recognize when the market is trending in certain direction. I would say the only difference between candlesticks and Heiken-Ashi is that Heiken-Ashi will illustrate the price gaps with the candle bar itself. So in other words, you can't really see price gaps clearly by using Heiken-Ashi candles. So if you are looking at, you want to understand price gaps, you want to look at price gaps, especially during opening gaps, session gaps, you still have to revert back to the normal Japanese candlesticks. Other than that, I think Heiken-Ashi serves a very good function to look at trends, to observe trends in the market for a particular period of time. So these are the 3 distinct patterns I mentioned. So clearly, when the bars are green, normally means it's an uptrend. Bars are red, normally means it's a downtrend. One of the important patterns you need to recognize is that, especially in the green bar, if you only see upper wicks, that means the uptrend is still quite solid. Downtrend, vice versa, you should only see lower wicks. Wicks are what we call candle tails. Now, if green bar appears with double candles, upper and lower candles, tails, then that we should be cautious. Usually it tells you that normally in an uptrend, when you start to see bars with upper and lower candles or tails, it means that the momentum starts to fizzle out. So in a trend, when market starts to trend, there's momentum. When the momentum starts to fade, normally you start to see there's in terms of Heiken-Ashi candles, you start to see upper and lower tails, and that's where you need to be careful. Now, when market starts to go from a trend to a range, or we call it consolidation phase, normally this is the third pattern we usually recognize, is where the tails of the bars are very long, or tails of candles are very long, and the bodies of the candles are very small, almost like a doji style when you look at Japanese candlesticks. So normally when you observe these type of patterns happening, or in Heiken-Ashi, usually it tells you that markets are starting to move from a trend phase to a consolidation period. Now, in a consolidation period, if you try to do trend or use trend tools, it will not work most of the time, because market is actually trading at a particular range. So just to put on dynamics, this is basically looking at Heiken-Ashi candles on a gold chart. So like I said, periods like this, you can start to see candles are very small, series of red and green candles. This is what we call a sideways market or consolidation market. So if you try to look at trends here in this particular box region, it's actually very difficult. Now, when you start to see appearance of green candles and the body of the candles are getting wider or longer, now it's telling you that, look, this uptrend momentum is starting. And this momentum is starting to build. So which is a good thing. So you want the momentum to sustain. That tells you that the trend can sustain. There's a higher possibility that the trend can sustain one direction. Now, the moment when the candles are getting smaller, or that you start to see appearance of red candle, that's where you need to be cautious, especially during an uptrend, preceding the uptrend or downtrend basis. So it's also indicate to you that, if you're holding on to a position, long position here, the moment you start to see that candles are getting smaller, the length of the candles are getting smaller, or appearance of red candle bar, you should be cautious. That will be a time that you should be pay a bit more attention. If you're still in the market, that will be a good time for you to be exiting your positions if you are still in profit. So vice versa, red candle bars, like I said, means downtrend. The wider it is, that means the momentum is still pretty strong. So that's how we use Heiken Ashi dynamics to really observe the market trends on a particular time frame that you're looking at. Now, Heiken Ashi alone may not be sufficient. So if you pair that with moving averages, that will probably give you a better indication to where you can enter or exit a particular market or entry levels. So ways of using moving averages, there's many type. I will highly recommend to use exponential. Now again, there's many exponential or simple or weighted moving averages in general are all lagging indicators. But it's useful in a way to determine where a trend is likely to form. Not only that, if you use moving averages actually mainly for crossover signals, that means you pair two different time periods of moving averages, one the shorter term, one a longer term. So the moment the shorter term crosses above normally indicates to you is a potential uptrend and vice versa. Not now, I think another function of using moving averages, which I think commonly people don't look at it much, is to use moving average as a way to indicate the dynamic support and resistance. Now you can draw support resistance to a vertical line, to a horizontal line, to a trend channel. You can also look at support resistance through the moving averages, which is more dynamic in nature. Let me explain. So what I have here is that looking at moving average, crossovers are simple. If you have a shorter term, in example, this blue moving averages line, which is a shorter period, is crossing below the red line. Just to indicate to you that generally this could be a potential downtrend in place. But what I want you to notice also is that you look at the candles forming, the Heiken Ashi candles forming, is holding well, or in a way is resisted well with this blue moving average line, which is the 9 period EMA. So in a sense that as long as these red candles are forming below the line, is indicating to you that this blue line can act as a resistance line. The moment it breaks above that, usually it tells you that okay, market is breaking the resistance. It's showing you sign that the trend is changing. So not only moving averages can use as a crossover, it can also use as resistance, dynamic resistance, and support levels accordingly. Example here, this section as well, you can see red candles are forming, although there's indication that the market can in certain time is consolidating, but you can see that the candles are still well resisted with the blue line here. So it's telling you that this downtrend is still persisting despite certain time periods showing to you that the market is consolidating. As long as there's no clear penetration above these two lines, the market is still generally a downtrend market based on the technical reading. Now, I also want to introduce to you a DMI indicator, which is actually mainly function more of once we identify where the trend on the market behaves, whether it's uptrend or downtrend. I think it's important to also undertake where we want to be in a trend when the momentum is just building up. We don't want to be in a trend where the momentum is almost fading, or we are almost end of the trend. I think one great way to measure the strength or the momentum or trend is what we call ADX line, which is part of a DMI indicator. So DMI indicator have three major lines. We have a positive DI, minus DI, and the ADX. The ADX one is a major focus in this slide, which is part of the DMI indicator. So this bottom panel is basically a DMI tool. So you can see the red one is basically a minus DI, your green one is your positive DI. So the moment the minus DI crosses above, it's telling you that market is downtrend. So in a sense that DMI crossovers and moving average crossovers are very similar signals. So a lot of people can choose that, okay, I just want to go with moving average crossovers. I don't need the DMI cross because it's giving an overlapping signals. So the more tools or indicators that you rely on, the more decisions time that you have to spend on to make a final decision. So the less tools you have is actually better. But I think it gives you a good guide. So if you don't use DMI crossovers, if you just stick to moving average crossover, it's still fine. But what I want you to notice is that as the gaps gets wider between the red line and the green line, or the minus DI and the positive DI, you notice that actually this particular downtrend is actually gaining momentum. So the ADX line is actually measuring the distance between these two lines. So basically, it runs on a value. ADX runs on a value, so it's between 0 and 100. So anything, the common rule of thumb is that anything that is above 25 tells you there's a trend forming. Anything that's below 25 or even 20 is telling you the market there's no trend or market is range. So if you know market is ranging, there's no point for you to look at trend in the market. So we have here clearly this black line here is your ADX line, showing you very clearly that during this downtrend, ADX is rising. Showing you the moment. This downtrend momentum is actually quite strong. So careful when ADX starts to pick around here. You can see that it's getting a bit more flattish and start coming down. So it's indicating to you that this downtrend or this preceding downtrend is almost fading out. So if you are still holding short position, you should be careful when ADX starts to go flat or starts to come down. So I think usually that's indication to you that eventually I think the market is probably going sideways. So same goes for here. You can see the immediate short-term forming of a red hair energy bars. ADX is rising. There is clearly a downtrend in place. But again, the momentum starts to fizzle out. It's still above 25, still indicating to you that the downtrend is still quite, there's still momentum in that. Just that the momentum starts to lose out or starts to fade. But crucially, always watch out where the candles, if it does break above the moving averages, usually it means that there is a change in particular trend for the particular market. So last but not least, I think in any trading strategy you must have, or trading style that you use, you must have a way to get yourself out. So what I always advocate is looking at average true range, which measures the range of a particular period, the high and lows. So what I have here is that you look at this bottom panel, the ATR. This is the daily ATR for gold. So if you recall, I think back in early part of this year, before that, I think gold was trading about less than 100 daily, $100 US daily range. Now I think on average you're looking at about 150, and at the peak I think it was almost 300 daily range movement in gold market. So it's actually a very volatile market. In fact, I think gold has experienced greater volatility. So greater volatility means greater risk exposure that we have to acknowledge. So therefore, it's always important that you must have a proper risk management in place. So interpreting ATR is very simple. Low ATR usually means that it's smaller price movement. This usually also comes with when markets are range, when there's less movement in the market, when there's a fixed range. It also indicates to you that normally the market is in a consolidation phase. Now, when the markets are trending, it breaks out a certain range. Normally, it means higher ATR value. So if you recall back looking at this slide here, when the ATR starts to rise, you can see that actually this uptrend rally also in the gold market, or the breakout rally in the gold market starts to form as well. So ATR can also be a good gauge as to when the market is trending and not trending. So low ATR usually signify the market is range. High ATR value usually means that the market is actually trending. So if you put all that in context, if you combine, so technically we can form a particular strategy. So what we have here is that the moment you start to see green Heiken energy bars and the candles are above both the moving averages, technically this is a good entry for us to take a long position. Importantly to watch, if the black line ADX is rising above 25 and is rising, the key thing is rising, it does indicate to you that this uptrend is building momentum. So ATR value, which at the bottom panel here is showing you 25 at this particular period. So if you put that all together, this is how you create a trading entry. So long target at 4644 based on the chart. ATR value is 25 based on the time frame we are looking at. Risk to reward ratio 1 to 1.5. Now, risk to reward ratio is very personal. Like I said, when markets are more volatile, you tend to aim a bit more lower risk to reward. That means you look at more opportunities or more frequency of trades. Now you can adjust higher reward with the amount of risk that you're willing to risk. But do be mindful, if you use ATR as a value to measure your risk or base ATR value, when ATR starts to go higher or starts to increase its value, that means you have to prepare to take a certain amount of risk as well. So your target profit is set as such for a 681.5, which is 1.5 times of your ATR, and your stop loss is basically one ATR value, which is 25 points. So that's pretty much how we sum up to create a simple strategy to look at the gold market. Now, if you look at where technical is, I think this was taken in the afternoon. So I think right now the market as of what we are talking now, I think the market is heading lower. You can see that generally the candles are pointing to you. It doesn't break the upper moving averages, and the candles, despite is showing you like a bit of dodgy and whatnot, the ADX is above 25. It does indicate to you that this preceding downtrend is still sustaining its momentum. No, although there's a flattish ADX, we just have to wait for further candles to show that it's pointing downwards. If that's the case, ADX will start to rise. It's showing you that this downward momentum is still quite intact. So your ATR is about 20 points. It does indicate to you that market is still pretty much a range, but I think the ATR has actually changed on just a couple of hours ago. So it does indicate to you the short-term technical trend for gold is still pretty much a downtrend momentum for now. Now, silver is slightly more on a positive side, but again, you can see that appearance of red candle bar on Heiken Ashi, and the candles are starting to move below the moving averages. Again, it's also pointing to you that it's a possible downtrend in place as well. Now, ADX is still pretty flat at 20, doesn't indicate to you there's momentum. But I think ADX now will probably, if you just look at the latest chart I have, I mean, on your end is looking at ADX rising. So that also pointing to you that this is pretty much a similar technical short-term downtrend on the silver market as well. Now, I'm just not going to go too detail on the micro gold. This is basically a contract specification. So basically 1/10 of the size. If you look at the normal gold contract, one contract is 100 troy ounces. This is only 10 troy ounces. So in a way, it's just much smaller contract to participate. So if you want to gain exposure in the gold market, I think the best product to start off with is always looking at the micro gold. So basically this is a margin. I think margin right now is about 2,800 US dollar. So the big contract one lot will be 28,000 US dollar. So that's quite a big contract. So right now we are the micro contracts. It's actually making the contract smaller. So in the sense that it allows more people to participate in the market. Now these margins are usually they do change time to time given the volatility of the market. If you want to get the latest margin, please do ask Philip at Philip Capital. They're more than happy to share you the latest margin. But I would say I think the micro contracts is a very good exposure. If you want to kickstart your exposure in the gold market, micro contracts is the best way to go for now. Now, since micro contracts are pretty new, I think it was introduced almost 2 years back. A lot of people will say, hey, is there volume in this kind of market, in this kind of contract? Now, you'll be surprised. I think even as a start, when initial contracts, when it was introduced, you can see that daily volume was about between the circle of 100 to 250,000. Now I think it's easy to 1 million. Obviously, with markets more volatile these days, you can see that gold itself is almost touching 800,000. Silver itself also touching almost 800. So total combined, you're looking about easily 2 to 3 million daily contracts volume for the micro precious metal. So it creates a lot of interest. It creates a lot of opportunity. So therefore, it creates participation. So there's no issue on liquidity. Really, I think it's the best time for you to participate in the gold market by using the micro contracts. So I'm just gonna end here with a note that if you are trading on a full-time basis, or rather you want to look at trading on a full-time basis, trading is really it's a way where you really need to have that consistency on hand. A lot of people are too fixated on results, whether it's a win or a loss. But if you look at trading as a long-term journey that you strive through, at the end, what matters most is actually the consistency that is required. So there's no point, one big gains, but eventually if you have subsequent losses that actually wipe out the gains, it's also quite pointless. So really, I think at the end of the day, the message I want to point out to you, if you're thinking of doing full-time trading, is try to find or try to strive for consistency and rather discount that immediate result, whether it's a win or a loss. So I'm just going to end here. I'm just going to hand it over to Aiman for any questions from the audience. Aiman?
All right, Aiman. All right, so if you have any question, you can just type in the chat box and we will check it for you, and Mr. David Ng will happily to answer those questions. So I will be think I will be give around 2 minutes. If you have
Sure.
any question,
Yeah.
you can just type in the question box. I think there's one question about what gold fund to buy.
Okay. So I just want to add clarity to that question. I think the topic today's session is mainly talking on futures, gold futures. I think that's where my specific is. If you ask me on gold funds, gold related funds, whether it's ETFs or not, I may not have that necessary because I myself don't do those products. I only mainly do the gold futures.
Okay, thank you, Mr. David. So, is there any other question? You can just type out and we will answer accordingly. On to follow up the question about the gold fund, there's people asking about which gold features that you may think uh, to buy.
You okay? I hope I get the question right. Which gold futures to buy? Is that right?
Mhm. Yes,
Yeah.
correct.
Okay. Now, the buying and selling, I can't comment too much. Again, this is purely for educational purpose, not a recommendation. Now, gold futures, I would say, if you are looking for gold futures, I think the best market to look at is still Comex, and I think in the last couple of slides of my webinar, I mentioned a lot on the micro contracts. I think it's a good product to look at as a beginning or as a start if you want to gain exposure in the gold futures market because the contract is small and it's a bite size. So therefore, I think it's not like those days. If you want to gain exposure in the gold futures market, it's not easy. You need a lot of capital. Like the big contract, easy right now the margin is 20,000 US dollars. So that's almost like 100,000 ringgit. It's quite expensive. So right now, I think with the small contract with the micros, it's actually making things easier. So it's 2,800 US dollar per contract basis. In a way, is more attainable. So I'll say start off with that product, in a sense that because and also is highly liquid, and therefore I think is a if you are new, it's the best way to start in that micro contracts. Now, obviously, there's also other exchanges that offer the gold futures market, but I think so far CME or rather Comex Exchange is still quite a leading benchmark for the gold futures market uh, in the world.
All right, thank you, Mr. David, for the explanation. And I think the got last question about can you share the EMA setting on the chart you share?
Yeah, sure. So the EMA settings on the chart, the two different periods. The shorter period is actually the 9 period EMA. The longer term period is a 20 period EMA. So that's how we get the crossovers. Now, if you want to understand the longer term trend on the daily chart, that would be using the 50 period EMA and the 200 period EMA.
Okay, thank you for the sharing, Mr. David. So I just wrap up this session tonight. So just to mention about our promotion again, uh, this webinar tonight is about CME. So this is a promotion on CME. When you open an account, you can entitle and subscribe to CME Exchange. You're entitled to get 100 ringgit trading credit, and you can enjoy the protection up to 100 ringgit and earn monthly reward when you trade more and more CME micro contract. And this promotion until 31st July this year. And a promotion on the CFD, you can get real-time market data. You can trade less capital using CFD compared to the normal stocks. And this is our online account opening QR code, and we will bring you to our website. To open account for stocks account, futures account, you want to open a CME account, to trade CME account, you can just open through this QR code and open through online. And if you have any question, you can just contact us through our social media, Facebook, Instagram, or you can just visit our website. We have a live chat there. And also you can check our Telegram and also TikTok. So this is our Telegram. For stocks is on up above. You can join our group, and there's info on stocks and info on the futures and CFD is on the bottom. So you can scan this QR code and join our Telegram channel. This one is legit. It's not a scam Telegram group. So if you have any question or want to visit our branch, you can just contact or email our branch listed here. You can take a screenshot. So any question, you can just email or call, and our dealer will assist you. Okay, that's it all for today webinar. Thank you, Mr. David, for this insightful webinar. And I will want to say thank you for joining our webinar tonight also. And happy evening for today. And Selamat Hari Raya.
Yeah. Thank you for having me. Good night.